Hello there, my name is Tejas and welcome to Trendline's interesting technical trends in Nifty 50 and Bank Nifty. In this video, we'll be looking at the open interest from the option chain data of Nifty 50 and Nifty Bank indices. With the help of this data, we'll plot the resistance and support zones, finally arrive at a trading range for the indices over the next few weeks. So before we get into the open interest analysis of the option chain, let's briefly understand what options mean. As the name itself suggests, it gives the option holder an option to buy or sell an asset. A call option is a contract that gives the option buyer the right to buy an underlying asset at a specific price within a specific period of time. Whereas a put option is a contract giving the option buyer the right but not the obligation to sell. Now let's take a look at an option chain from Trendline's option dashboard. The left part here shows the call option details and the right side shows the put options. For May expiry, LTP is the last traded price of the option contracts. One of the more important parameters of the option chain detail is the open interest data, as it helps to analyze what is happening in the underlying security. Open interest is the total number of outstanding option contracts that have not yet been settled. So in this monthly option data expiring on May 26, we can see, for example, for different strike prices, we have different number of open positions that have not been settled. So the change in OI shows the percentage of change in open contracts for a particular period of time. Now let's see how an open interest change graph looks with an example. So on May 19th, the Nifty 50 saw its biggest fall in over 3 months. It fell 2.65%, while the Bank Nifty fell 2.48%. If you look at the open interest chart here of Nifty 50 May 26 expiry, we can clearly see that the red bars representing the calls sold at different strike prices were very high, especially at 16,000, 16,100 and 16,200 levels. So this means traders sold a lot of call options at these levels. This could be because they believe that the Nifty 50 won't cross these zones. And because of this, there was a short buildup at these levels. And these zones acted as a resistance, which is a level that prevents the index from rising further as sellers become active at this point. And towards the right part of the screen, we can see inverted green bars at 16,000 and 16,200 levels mainly. This means that the lot of active put option contracts at these zones were closed. Closing of put contracts leads to weakening of that particular support zone, as those traders no longer believe that the index won't breach that zone. So on this day, traders sold about 39.6 million calls as opposed to 15.7 million puts, meaning traders sold a whole lot of calls expecting the index not to rise and thus creating a stronger resistance, which indicates a bearish trend. And what happened the next day was a rebound. Nifty 50 recovered all its losses from the previous day and more, as it rose about 2.9%. Let's take a look at the option interest change on this day. So what jumps out from the chart here, that there are several red bars and a lot of green bars on the left side of the screen. The long green bar at 16,000 level shows that traders sold a lot of puts at this level, expecting the index not to drop below this, and thus strengthening the support. The inverted red bars indicate that the total number of call contracts at these levels decreased as traders closed their position, leading to weakening of resistance at these zones. In addition, a very high number of puts were sold on this day. The green bars represents the puts here, and a lot of them were sold as traders believed that Nifty 50 won't breach these levels, so that they can pocket the premium that they received while they sold it earlier. However, as we saw in the previous slide, this can change, especially when there are big swings in the index. Now coming to the Bank Nifty, we can see the contrast between the open interest graph of this index on May 19th when it fell by 2.48% and on May 20th when it rebounded by 2.88%. Like Nifty 50, we can see the same trend here as well. There were a lot of calls sold on May 19th when the Bank Nifty fell, leading to several resistance zones. However, when the index rebounded on May 20th, a lot of these call positions were closed. This is called short covering. And a lot more puts were sold, creating support zones. So whenever there is a big swing in the markets, the short-term resistance and support become dynamic and move more often. Moving to the open interest change of Nifty 50 May expiry on May 25th, we can see that traders sold a lot more calls compared to puts. The put to call ratio or PCR is at 0.6, indicating a bearish sentiment. PCR ratio of less than 0.8 represents a bearish view, whereas anything above 1.2 indicates a bullish trend. The magnitude of calls sold is considerably higher at 16,200 and 16,500, which may act as a resistance in the short term. On the other hand, there is support at 16,000 and 15,800, but not as strong as the resistances because the number of puts sold at these levels are not high as the calls sold at 16,200 and 16,500 levels. Let's take a look at the open interest for Nifty 50 June expiry now, as it can provide us with insights to determine a likely trading range. Looking at this open interest data, Nifty 50 has a very strong support at 16,000 level and a strong resistance only at 16,500 as of May 25th. There are a lot of puts sold here at 16,000 level, indicating investors expect the index not to go below this level so that they can keep the premium. Put to call ratio is at 1.3, indicating that the traders are bullish as they have sold a lot more puts than calls. However, we need to look at what the option chains of heavyweights are indicating. Stocks like Reliance, HDFC Bank, Infosys, and HDFC constitute to around 35% of the Nifty 50. So it's important to look at the open interest data for these stocks as well. Let's get into it. So looking at the open interest data of Reliance and HDFC Bank, we can see there is a divergence with traders' views. While there is a bullish trend in June expiry for Nifty 50 option contracts, traders have a bearish view on the stocks that have high weightage in Nifty 50. Both the graphs show several strong resistance with weaker supports. In addition, the put to call ratio are also lesser than 0.6, that indicates a bearish view. And this trend continues in HDFC and Infosys as well, as the number of calls sold is higher than the number of puts. And this divergence of views can indicate that the volatility may continue to remain at elevated levels as traders are indecisive. Even though the next month Nifty 50 option contracts are indicating a bullish trend, its top four constituents, which make up about 35% of the Nifty 50, have a bearish sentiment. Hence, we should consider this while constructing a likely trading range for the index. With the open interest analysis in mind, we can now construct a likely trading range for the Nifty 50. And given the fact that there is a divergence of views, we need to widen the trading range accordingly. So looking at the high number of calls sold at 16,000 level, this zone will act as immediate support for the index. If this is breached, strong support zones are available at 15,500 and 15,000 levels as indicated by high open interest. Coming to the resistance, immediate resistance is present at 16,200. After this, 16,500 and finally 17,000 may also act as resistance zones based on the high open interest. If you plot it on the price action, it looks like this with different support and resistance levels. So to round it up, Nifty 50 may trade in the range of 15,000 to 17,000, given the fact that open interests are high as of May 25th. This is of course contingent on the fact that there are no big moves in its top constituents that can in turn affect the index. Next, let's take a look at a Nifty Bank open interest data. Now looking at the Nifty Bank May expiry, the monthly OI graph shows the calls and puts are evenly distributed with a put to call ratio of about 0.8 with a little higher number of calls sold. This indicates a neutral view. Important resistances are present at 35,000 and 34,500 and a strong support at 34,000. However, it is important to know that the trading range is dependent on the stock price reaction of heavyweights such as HDFC Bank, ICICI Bank. Any big moves in heavyweight stocks may in turn prompt the Bank Nifty to breach the trading range. The same trend continues in June expiry option contracts as number of puts sold here is nearly the same number of calls sold, taking the put to call ratio to 1. This means investors are indecisive and the Bank Nifty's trend is going to be a very rangy one. Given the fact that both May and June expiry option contracts are indicating a neutral stance for now, the direction of the trend may vary in the next month. So if we plot this on TradingView, we can come up with these resistances and supports. The highest resistance is at 37,000 and the lowest support is at 32,000. As the traders are indecisive of the trend, the trading range may be wider in the next month. As of May 25th, based on open interest data, Bank Nifty may trade in the range of 32,000 to 37,000. To round it up, Nifty 50 may trade in the range of 15,000 to 17,000 for the next month's option expiry because there is support and resistance at this level based on the open interest data we analyzed. Given the fact that the heavyweight stocks aren't showing the same bullishness that the Nifty 50 is showing, markets may continue to be volatile. And with regard to Nifty Bank, we saw that it may trade in the range of 32,000 to 37,000 provided no big swings in its top constituents. This can be useful for traders on expiry day trading or for any other trading strategies. You can find the futures and options data and more on trendlyne.com for any stock or index of your choice. This is Tejas signing off.